And here we are. I'll just check on the housekeeping elements. It all seems to be in order. I'm sure we'll start to see the delegate number creeping up very shortly. So good afternoon and welcome to the third live event of our free content-led live sessions taking place throughout November and December as part of the Professional Accountancy Online Live. Sponsored by Free Agent with me, Tony Stevenson, and our expert speaker, Michael Rick. So during today's live session, offering an hour of CPD, you will be able to listen to Mike present on case studies on the impact of Brexit on the UK financial reporting and auditing landscape. Presentation will cover the Companies Act 2006 and regulations, including references to EU adopted and EEA, what changes will arise as a result of Brexit, and what do entities need to do to consider these before they arise. The session will look at a number of case studies to highlight the issues and identify some possible solutions. The session is based on the current pronouncements. Mike has prepared a PowerPoint presentation which will be on the screen during the lecture. You will be able to download a copy of the presentation using the buttons on the right-hand side. He has also prepared a supplementary lecture notes document which you can also download again on the right-hand side. There will be an opportunity after the presentation to ask a couple of questions. So on the right-hand side of your screen, you'll see a chat function. All the questions are submitted in private, so please ask away. If you're watching a replay, then obviously the live chat function is disabled, but you may want to contact Professional Accountancy for further information. A recording of today's live session will be sent out via email, so you don't need to ask us. That's gonna happen within a couple of days, so please keep an eye out for that. So on to our introductions. So firstly, myself, Tony Stevenson. So for those of you that don't know me, my name is Tony Stevenson. I'm a practice implementation consultant at Free Agent, where I help accountants to get the most out of Free Agent's award-winning online accounting software. I say award-winning, we actually won 3 awards at the Accountancy Excellence Awards recently, which we are absolutely delighted with. I did hear somebody describe them as the Oscars of accounting, so we're pleased with that. I spent the first 10 years of my career in practice as a corporation tax consultant before moving into the cloud accounting software industry. Since then, I've been using my experience to support both small businesses and accountants through cloud accounting software. I am, for my sins, a fellow of the Institute of Chartered Accountants for England and Wales, believe it or not. Free Agent, who I work for. So Free Agent, UK-based award-winning online accounting software designed specifically for small business owners and their accountants and bookkeepers. With over 100,000 active users, Free Agent's powerful end-to-end accounting functionality simplifies the admin associated with your small business clients, gives you the robust features and proactive alerts that your practice needs. More information can be found on Free Agent at the online exhibition at www.profaccountancy.com, or alternatively, you can visit www.freeagent.com. So without further ado, I can introduce today's speaker. It gives me great pleasure to introduce Mike Ulrich, ACA. So Mike has been involved in presenting courses and seminars to professional accountants for over 20 years. He is a technical consultant on accounting and audit matters to a number of firms, providing answers to real-life issues. He also undertakes compliance reviews, both audit and audit exempt, for a number of firms, and provides advice and guidance as required. Both of these provide him with a unique insight into these topics, which are of practical interest to practitioners and accountants in commerce. He has his own practice and he's a statutory auditor. With this background, it enables him to see both the theory and practical aspects, and the presentation reflects this. So welcome, Mike, and over to Mike for the next 45 minutes before we move on to the questions.
Thank you very much indeed, Tony. So welcome to this webinar with regard to Brexit and changes. Just to emphasise the fact that we're not discussing any of the politics here with regard to Brexit. We're really looking at here the impact that there will be as far as accounting aspects are concerned. So we're primarily looking at here the Companies Act 2006 and its associated regulations. So perhaps what we need to do here is just to cover the format of today's presentation, which is we need to look at the current requirements and to remind ourselves of some of the issues. And I will be straying what I refer to as a little bit off-piste here, because I will also be highlighting some aspects which arise as what I refer to as common misunderstandings when I'm having discussions with accountants. I always refer to them as misunderstandings because they're a misunderstanding. If you haven't done it, they become what's called an error if you've already done it. So we'll just classify at the moment under the terms of misunderstandings. We'll therefore need to look at the change that Brexit is going to have and the effect of that change, and put that into the context then of a particular case study. Now, for the purposes of the case study, I'm using exactly the same format throughout. So we have here what I would refer to as a small group. So subsidiaries A, B, C, and D are all based in the United Kingdom. And what we will be doing effectively is highlighting various aspects for that parent at the very top being in different locations. Those locations are simply in the United Kingdom, within the EEA, and outside the EEA. Now, the reason why I've adopted this particular structure is because one of the impacts that's going to arise is the impact on what is called, or what I call, intermediate parents. And in this particular context, subsidiary A is what I call an intermediate parent. It is both a parent of subsidiaries B and C, and it is also a subsidiary of the top parent. And that just creates another situation as far as these regulations are concerned. So by way of introduction, I suppose the first thing we need to cover is when are the changes actually going to apply from? And they will apply from IP completion day, which is a term that is used within the regulations. An IP completion day is the 31st of December 2020. So it will be for accounting periods commencing after that day. So I suppose for many accountants listening to this presentation now, this simply means no impact until you get to around about December 2021, and then think about it in 2022. Well, the situation here is that some of these changes are going to be what I refer to as far-reaching. And as I've always indicated to practitioners that I speak to, early warning is always best. Early warning is always good news, because effectively it means you can make changes as necessary to be able to accommodate whatever the issue is going to be. And I will emphasize, some of these changes are going to be referred to as being, well, in many instances, almost irrelevant. You just don't come across them that often. Other ones, for example, the application of section 479A in respect of audit exemption, I think could be in actual fact quite significant, and that could have a big impact on businesses in the United Kingdom. So moving on from that, therefore, what can we observe at this stage with regard to the background? At the current time, the UK is aligned to the EU from the point of view of both financial reporting and auditing. Both of these are covered under EU directives, and I don't think any of that will change rolling forward into the future. Yes, I have spoken to some practitioners, what I may refer to as the older generation, who would love to see the UK ditch FRS 102 and adopt some of the old SAPs. And I can appreciate the impact of that. After all, there will be people who are listening to this presentation at the moment who haven't got a clue what I'm talking about at this particular stage. But just to put it this way, if you go back historically, UK accounting standards might have been contained within around about 3 pages of A4 paper. That's opposed to FRS 102 at the moment, running to around about 350. Well, despite the fact that some people might think that's a good idea, at the end of the day, we need to appreciate there is a global objective to try and make GAP global by nature. In other words, to get comparability on a global basis. That's why FRS 102, which is basically IFRS for SMEs adapted to the UK, that's why it's been brought in. It just gives us that particular aspect. With regard to auditing, well, there might be changes in auditing. They're not going to be driven necessarily by the European Union. They're more likely to be driven by changes that have actually occurred within the United Kingdom. No doubt those of you who are listening to this presentation, who are auditors, would appreciate it's been a bit of a rocky ride over around about the last 2 years, with what I refer to as a couple of high-profile instances which have raised some pretty serious questions over the value of an audit. But fundamentally here, as far as this is concerned, I don't think we'll be changing very much from the point of view of compliance with those directives and remain broadly in line with them. So if we're going to be leaving the EU and we're going to be leaving the EEA, then we need to appreciate that the Companies Act 2006 does make references to both of these. In actual fact, in terms of which is the more frequent, it is actually references to the EEA, not to the EU. So just to remind you what the difference is here, the EEA is wider than the European Union. So it does include Norway, Liechtenstein, and Iceland. So I suppose that raises the question, therefore, are we leaving the EU and remain part of the EEA, or are we effectively leaving both? Well, to be a member of the EEA, you have to be part of the single market. And without getting into any of the politics of this particular point in time, I believe the current indication is that the UK will be leaving the single market. Therefore, we will not be part of the EEA. And that's very much the assumption that has been made in the regulations that have been passed to date. So I'm making the assumption for the purposes of this presentation that we will no longer be part of the EU and we will not be part of the EEA. If that's not correct, then obviously there'll be other considerations, and that may have to be covered by another webinar at some time in the future. So let's start on the detail here, first of all, with regard to preparing financial statements under Section 395 of the Act. All UK companies, with some exceptions for dormant companies do have an exemption, which I'll refer to fairly shortly from the preparation of financial statements, but all other companies in the United Kingdom are required to prepare individual accounts. Now, they can use various formats with regard to that, but those broadly break down into two categories. Those which are prepared under the Companies Act by way of UK standards, and those that are prepared under international standards, which, as it stands at the moment, is EU adopted IAS and IFRS. Now, some entities are also required to prepare group accounts. Just because an entity is a parent, it doesn't automatically mean the group accounts have to be prepared. And as part of this afternoon's presentation, I will be looking at those instances where there are the exemptions and where the aspect of Brexit may have a particular impact. So as far as this is concerned, as you can see from this slide, all that will simply happen as from accounting periods commencing on or after the 31st of December 2020 is the reference to EU adopted IAS will become UK adopted. Now, on that particular date, so on the 1st of January 2021, what will be the difference between UK and EU adopted? I would suggest the answer will be none. All that will simply happen is the FRC will have a formal process for adopting the international standards. And it's not part of this afternoon's presentation to cover perhaps those international standards that have not actually been adopted by the EU. All we can observe at this particular stage is that in the early days, there will be no difference. Whether that remains the case as we go forward into the future is uncertain. So this particular change will only affect those entities that are applying international standards, and it will only affect them in the terms of a slight changing as far as the wording is concerned. So therefore, the UK will formally adopt exactly the same standards on IP Day. So if at the moment you're using FRS 102 or FRS 105, there will in actual fact be no changes at all. You will just carry on using those standards, which will then be updated by the FRC as part of their review process. So Section 394A provides a process by which certain entities can actually get an exemption from the preparation to prepare individual accounts. As I've just indicated, this is really for dormant subsidiaries. So it is a requirement. It has to be a subsidiary. It is a requirement. It has to be dormant throughout the whole of the period. Now, dormant here is as defined by the Act, not by any other definition at all. There is a formal definition of dormant within the legislation. And as it stands at the moment, the parent has to be established under the law of an EEA state. Well, all that will simply happen here is the term EEA will be changed to the UK. So my apologies with regard to this particular slide. For some unknown reason, the strike through has gone through all of the text rather than just references to the EEA state. So provided the parent is established in the UK, it will not make any difference as we make our way forward. Now, in order to be able to apply these requirements, the parent has to prepare group accounts, disclose the subsidiary is exempt. The subsidiary has to file a copy of the consolidated accounts, plus audit report and annual report as appropriate. The parent has to give a guarantee, and all the members of the subsidiary must agree. Which I suppose if you're looking at the difference between preparing the financial statements and taking the exemption, it has to raise one particular question. Would it overall be easier just to prepare the financial statements in the first place? So I'll be quite honest here. I do not see in practice many instances where this exemption is actually used. In many instances, the decision has already been made that it's possibly easier, more efficient, and cheaper to just go through the process of preparing the financial statements themselves. Now, in the example that we're looking at here, so I've made the assumption here that subsidiary D is dormant. So if the parent was in the UK, then, if the parent was in the UK and subsidiary D was using the exemption, then there's absolutely no problem in making our way forward. However, if the parent is in Germany, then up until the 31st December 2020, so only affecting accounting periods commencing on or after that date, that exemption would no longer be available and subsidiary D would have to prepare financial statements. But as I've already indicated, I wouldn't see that as being onerous at all. Of course, if the parent is in India, then that is not part of the EA and the exemption would never have been available in the first place. So if it is being used, I suppose the important thing to remember here is if that parent had actually been in Germany, and you had a December period end, so your financial statements of the 31st December 2020 would have been okay, but making your way forward to the 31st December 2021, you'd have to prepare financial statements and file them with the registrar. I suppose it's a simple case here is, are you going to remember to do that? Because if you don't, obviously, there will be a late filing penalty. One of the areas which is going to create a number of changes is the whole aspect from the point of view of intermediate parents. So as I mentioned earlier, the subsidiary A in this particular setup is what I refer to as an intermediate parent. It is both a parent and a subsidiary. So what we therefore need to consider is, does subsidiary A need to prepare group accounts? Now, within the Act, there are exemptions available to it. Now, those exemptions broadly break down into what I refer to as three main categories. One, if subsidiary A heads a small group, then it gets an automatic exemption from the preparation of group accounts. The next grouping that provides an exemption is if subsidiary A, together with B and C, are consolidated further up, then it will get an exemption. Those exemptions will be under section 400 and 401. The third aspect would be is that if B and C are not material, then subsidiary A could take advantage of the exemption with the Act itself, because there is no point, there is no requirement, therefore, to prepare group accounts if B and C are not material. Now, in looking at material here, that is both of them together, not on an individual basis. So I'm not going to worry about the last one because there really is no impact as far as Brexit is concerned, but I am going to worry about the first two. Why? Well, for the first one, that is if it's a small group, there are no fundamental changes here as far as this is concerned, but Brexit could have an impact in terms of what is the definition of small. And that is, in actual fact, is advantageous, not more onerous than it would have been in the past. With regard to the second aspect of getting exemption for the preparation of group accounts, because your results are consolidated further up the line, then there is a change there between sections 400 and 401. So looking first of all at the small group, so the requirement would be if subsidiary A is a small parent, that means that fundamentally it heads a small group, then it gets the exemption automatically. Now, what determines a small group, I'm not going to go into in detail, but you need to satisfy 2 out of 3 between turnover, balance sheet total and employees, and also satisfy the requirements of the years rule. Now, the requirements here are shown for you on this slide, and here I have to make an apology. I was going through this yesterday and noticed that I've actually got these columns reversed. So where there is gross, there should be net, and where there is net, there is gross. So when we're looking at whether A actually heads a small group, we need to satisfy 2 out of 3. And it doesn't matter here whether we're looking at the net or the gross. You don't have to satisfy both. You only have to satisfy one of them. and you don't have to satisfy the same one. So, for example, you could satisfy turnover on a gross basis and balance sheet total on a net basis, and that would comply with the requirements of the Act. So it's an appreciation here, I suppose. You only have to satisfy one or the other, not both. But also a reminder here is that the balance sheet total is total assets. It is not the figure that naturally appears on the balance sheet. This is a misunderstanding that does occur occasionally. As far as employees are concerned, there is a definition of an employee within the legislation, and it is a person who is employed under a contract of service. Now, one item that may make an impact here in the future is the movement towards bringing some off-payroll individuals who are working through their personal service companies onto the payroll in the future. But those changes won't come in until the 6th of April 2021, and even when it does, I don't think personally that will make any difference to employees as covered by the Act. They still will not be employees in terms of the 50 that I've already mentioned. So in order to be a small parent, you must head a small group. But more importantly, not only must you satisfy the criteria to be a small group, you must not be a member of an ineligible group. So if you were to satisfy all the small company criteria in terms of the 2 out of 3, then you also have to look at you also need to look at that entity's membership of the wider group. And if it's a member of an eligible group, then it will not be small by definition. Now, in this particular aspect, an ineligible group will be if the group includes any entity which is admitted to trading in an EEA state. In other words, I suppose the common term here would be listed in an EEA state. So if it's listed in an EEA state, you cannot be small by definition. Now, we need to be very careful here because this aspect of an eligible group is different between small and medium sized. So for small, it's admitted to, for small, it's effectively listed in an EEA state. For medium, it's listed anywhere on a global basis. So what difference does this make at the end of the day? Well, whether A is small here or not could be crucially important because, yes, if it is small, it gives an exemption from group accounts. But if it's not small, it doesn't mean it's going to lose an exemption from the preparation of group accounts. It just simply means it will not get it automatically as a small parent. There are still the options, as I will discuss fairly shortly, with regard to sections 400 and 401. Perhaps for financial reporting purposes, the important consideration here will be the use of Section 1A. So Section 1A of FRS 102 provides a framework for reduced disclosure for small entities and is only available in this aspect to companies entitled to use the small companies regime. So as it stands at the moment, if the parent was listed in the UK or in Germany, then this would not be available because fundamentally the parent is listed in the EEA. As it stands at the moment, the UK is part of the EEA, even though we're within this transitional process. If the parent was listed in India, then it would create absolutely no problems whatsoever. So that means the change here, as we make our way forward, is in actual fact, if the parent is listed in Germany, because the change that will occur in terms of an eligible group will be if the parent is listed in the UK only. So if the parent is listed in Germany, all of a sudden subsidiary A could in actual fact be small, therefore would get the exemption from the preparation of group accounts on the basis that it is small. However, in terms of trying to work out what the impact of this would be, bear in mind what I said earlier. Even if you did not get the exemption as a small parent, there's a very good possibility that the exemptions under 400 or 401 would equally apply. So effectively, it doesn't mean it's going to be potentially that larger impact. So moving on those particular aspects then with regard to 400 and 401. So what we're talking about here is where the results of the UK parent and its subsidiaries are effectively consolidated further up the chain. So under section 400, the parent has to be in the EEA. 401 is if the parent is outside the EEA. So the change that's going to occur here in the future is the reference to section 400 will only be to the UK, not anywhere else in the world. Effectively, 401 will become the rest of the world as it is at the moment and the EEA. So you'll just switch effectively from section 400 to 401. So what are the requirements of these two sections? Well, the entity has to be included in the parent's consolidated accounts for the same date or an earlier date in the same financial year. So be very careful here if the parent period end is not coterminous with, in this particular instance, company A. We have to make sure that, first of all, we've been consolidated into the correct set of financial statements, which can be an issue if you like, in this scenario, company A is a new member of the group. But perhaps more importantly, in order to be able to use the exemptions of either section 400 or 401, we also have to deliver the group accounts to the registrar of companies, and it has to be for the relevant period end. So for example, if the period end is the 30th of June, but A's period end is the 31st of March, and let's just clarify this, there is no legal requirement that a subsidiary and a parent have to have the same period end. It's what I refer to as a preferred option under the Companies Act, because it uses the word should, it uses the word should rather than must. So it's not an absolute requirement. Anyway, if the parent's period end was the 30th of June, A finished on the 31st of March. So for its period end, the 31st of March 2020, it would file the group accounts for the parent of the 30th of June 2019, not the 30th of June 2020, on the basis that that is closer to the 31st of March. So some of the common issues that arise under section 400 and 401 is normally just trying to work out potentially which one you're supposed to be using. So I had inserted this as a bit of what I refer to as an interactive quiz, but don't worry, there'll be no quiz element at all. So I've chosen here 3 very common locations for parents of UK intermediates, Isle of Man, Channel Islands, and Gibraltar. And the simple question would be, for each of those, would you use either 400 or 401? Well, the answer is you'll be using 401 for the Isle of Man and the Channel Islands because they are not part of the EEA, but Gibraltar is. So you'd actually be using section 400 in that instance. So is there any real difference between 400 and 401, apart from the fact there's a one difference in terms of the section numbers? Well, the answer is not a lot, really. Section 401 does include a comparability requirement with EU accounting, but that's not going to make any difference as a result of this change, because if the parent is in the EEA, obviously it is complying with EU accounting. Perhaps the important thing here is the parent has to disclose the basis of the exemption. So you'd have to quote either section 400 or 401. So I suppose perhaps the biggest danger here is to continue to use section 400 when perhaps you should have changed it to 401. Excuse me. So from the point of view of medium-sized groups, so if you satisfy all the medium requirements in terms of the 2 out of 3, then in order to be a member of an eligible group, then you'd have to have a listed entity where it is listed anywhere on a global basis. So for example, if it was listed in India, which is increasingly common from what I can see as far as some UK accountants are concerned, then that would have an eligibility issue from the point of view of being medium-sized, but does not have an issue from the point of view of being small. So with regard to that particular aspect at the moment, if you're looking at medium-sized, it'll be listed anywhere on a global basis. So you would be a member of an ineligible group. The next topic to look at is extending the accounting period. Really, I suppose, for 2 reasons. Brexit does have an impact as far as this is concerned, and there is also a mechanism available that will potentially allow you to gain further time to actually file financial statements. So accounting periods are either extended or shortened, and you do that by changing the accounting reference date. And the Act allows you to shorten it as often as you want, but you can only extend once in a 5-year period with an exemption that is available. So shortening it is a method that is commonly used to extend the filing deadline. Now, I appreciate that some accountants are perhaps not aware of that, but I'm not going to go through that in detail because that's not part of this webinar content. But when we're looking at this aspect of shortening to get a longer period, you just simply shorten the accounting period by 1 day. As soon as you do that, you get another 3 months to file the financial statements, and you can extend the filing deadline for broadly around 15 months if you've got a 9-month filing deadline. Of course, things have now changed considerably because Companies House extended the filing deadline by 3 months for all entities in the United Kingdom. So if you are using that mechanism, which is actually often which was referred to recently as one of the most abused sections of the Companies Act, then please bear in mind it works slightly different if you started with 12 months in the first place. So moving on to the item, therefore, that is actually affected by that entire aspect with regard to Brexit, and it is the exception to the 5-year rule. A subsidiary can align its reference date to a subsidiary or parent undertaking provided it is in an EEA state. Well, you would have gathered at this particular point in time what's going to happen now. Any references to the EEA will just be changed to references to the United Kingdom only. So in order to be able to extend your accounting period, if you are a subsidiary or you are a parent, you can extend it to match another member of your group. Now, the easiest way of looking at this and its potential impact is to consider the same example that we've had so far. So let's say, as far as subsidiary A is concerned, in 2017, it had an accounting reference date of the 31st of December and made up its accounts to the 31st of December 2017. For 2018, it extended its accounting date to the 31st of March, so made up its accounts to the 31st of March 2019, effectively having a 15-month accounting period. In 2019 financial year, it's acquired by a parent on the 1st of January 2020. The parent's period end is the 30th of September, and its next set of financial statements is the 30th of September 2020. So as it stands at the moment, A Limited's accounting period will end on the 31st of March 2020, but it's now part of a group. And what the new parent would like is for the next set of financial statements to be made up for an 18-month period through to the 30th of September 2020. Well, why might it want to go down that route? Well, I suppose, simply put, it would be this. If there is a requirement to prepare accounts at the 31st of March 2020, that may involve some cost. There may also be a requirement for those financial statements to be audited. Therefore, it may be seen as being much more efficient to go through to an 18-month period to the 30th of September 2020, rather than having a period of 12 months to the 31st of March, followed by a period of 6 months to the 30th of September. But the problem here is that A has already extended its accounting period in the last 5 years, and therefore it is limited in its ability to do so in this particular example. So having already extended in the next 5 years would have to therefore apply the provisions within the Act to get an extension out to the 30th of September 2020. So if we're going to complete this with regard to this particular aspect, and if we apply it to the 31st of March 2020, there could be another aspect here as well, because A may also have to prepare group accounts because it won't be eligible for Section 400 or 401. Why? Because the accounting period of the parent finishing before the 31st of March 2020 would have been the 30th of September 2019. And because the acquisition was on the 1st of January, A would not have been consolidated. So therefore, it would have to wait until the next set of financial statements in order to be consolidated itself. So if we look at the example of the use of this particular exemption, so the left hand here is as it is at the moment. The right hand crosses and ticks are as it will be in the future. So if the parent is in the UK, then there's no problem here whatsoever. So if subsidiary A and its subsidiaries have been acquired by a UK parent, then extending the accounting period to the 30th of September is not an issue at all. If the parent was in Germany, then as it stands at the moment, you'll be able to extend and use the 18-month period. But in the future, you'll not be able to. You'd have to have a 12-month period followed by a 6-month period. If your parent has been in India, then you would not be able to extend. You'd have to go for a 12 and a 6. Now that may, as I indicated earlier, incur some additional costs. The next item is the one that perhaps we need to consider very carefully, because of all the ones that I've covered so far, I think to a certain extent, the impact of the changes may be referred to as being minimal, and in actual fact, for some instances, will be what I refer to as completely irrelevant. However, this one potentially has a very distinct impact, and it is the aspect of audit exemption. I'd also like to point out at this stage that I will be going what's called slightly off-piste here as well. Why? Because I see misunderstandings arising here on a fairly regular basis, where there is a misapplication by the directors of the entity of the audit exemption requirements in the United Kingdom. Now, I emphasize the fact that this is a misunderstanding by the directors, because fundamentally under the Act, it is the directors who have made this decision. Unfortunately, very often those directors have been steered or advised by an accountant. So although ultimately it's the director's responsibility, very often it's a misunderstanding by an accountant as to exactly how the requirements actually apply. So with regard to audit exemption, there are 3 aspects under the Act, and I'll only be looking at 2 of them. I am not going to be looking at the exemption for dormant companies under section 479, but I will be looking at small companies under 477 and qualifying subsidiaries under 479A. Why? Because the first one is where you often see the misunderstanding, and the second one is where there is a distinct impact from the point of view of the Brexit changes. So with regard to this, we also need to be very clear as to when these changes come in. Now, there was a certain amount of lack of transparency within the regulations making these changes. And if you look at the regulations themselves, it can sometimes be fairly difficult to work out when the start date is. So using the words of the ICAW, they have stated the section 479A changes will continue to be available for periods which commenced before exit day, which is 11 p.m. on the 31st of December 2020. So if your accounting period commenced after that, then section 479A will not be available, may not be available as a result of some of these changes. So before looking at section 479A itself, in terms of looking at section 479A itself, then the entity has to be a subsidiary, and the parent undertaking must be established under the law of an EEA state. So as far as this is concerned, then there are certain conditions that have to be satisfied. Firstly, all the members must agree. The parent must give a guarantee. The entity must be included in the consolidated accounts drawn up by the parent. The parent must disclose that the entity is exempt, and the directors have to deliver a written notice of the members' agreement, the guarantee statement, and a copy of the consolidated accounts. Now, this may raise the question with regard to section 479A as to exactly how popular, to use a term, it is in the United Kingdom. Well, from what I see in practice, section 479A is remarkably popular. It's quite a simple process. If you've got a parent at the moment in the UK or the EEA, and that EEA could be, for example, Germany, they can issue a guarantee and all of the entities in the UK will be exempt from audit. Now, of course, the reference here to a guarantee also needs to be looked at very carefully as well. So what the parent is effectively doing is guaranteeing the debts owed to third parties at the period end. And in many instances, that guarantee will be freely given. After all, there's a full anticipation by the parent that the subsidiary will in actual fact settle its debts with third parties. So satisfying the requirements here from the point of view of section 479A is often seen as being absolutely straightforward. So if we're looking at this particular example and the application of section 479A, what I want to do first of all is just to clarify one aspect from the point of view of section 477. If you're looking at the position of subsidiaries A, B, and C in terms of audit exemption as a small group, then please note you have to consider the entire group, not just the subgroup. Something which is perhaps misunderstood here is in determining a small group for accounting purposes, which I covered earlier, you only look at the group itself, that is the subgroup. When you're looking at audit exemption under section 477, then you have to look at the entire group. Let me give you an example. I was involved with a discussion with an accountant a few weeks ago who was trying to determine whether a small number of companies in the United Kingdom were entitled to audit exemption. He'd established that some of these were intermediate parents, and it established that the group within the United Kingdom would have been classified as a small group. And therefore, for some years, this sort of subgroup within the United Kingdom had taken advantage of audit exemption. As part of the conversation, it appeared that this subgroup was part of a much larger global group, which was actually made up of 73 entities on a global basis. So in order for that subgroup within the United Kingdom to be able to claim audit exemption, the entire 73 entities would have to satisfy 2 out of the 3 to be a small group. And it became fairly clear that that was not the case. End result for this accountant, this new client they'd just taken on would not be entitled to audit exemption. More importantly, had not been entitled to audit exemption for a considerable number of years. So bear in mind here fairly carefully that when you're looking at audit, it is the entire group, not the subgroup. In other words, as I just said, the requirements for audit and accounting are not the same. So the change effectively here is going to be, and this is the significant one, the parent would have to be in the UK, not just in an EEA state. So moving that forward then to our particular example, this is the position currently. So if the parent was in Germany, it could issue the guarantee to subsidiaries A, B, and C in the United Kingdom, and therefore A, B, and C would be exempt from audit. Almost certainly, obviously, they've got to be consolidated as far as the parent is concerned in Germany. If the parent was in India, you'd never be entitled to the exemption at all because India is not part of the EEA. But in the future, if that parent is in Germany, then it will not be able to issue the guarantee. So subsidiaries A, B, and C will not be entitled to audit exemption under 479A. And given the circumstances, it may be likely that it's not entitled to audit exemption under section 477 either. Therefore, these 3 entities will be required to have an audit, possibly for the first time in many years. When you see these situations arising, very often this audit exemption has been in place for a considerable period of time. In other words, the entities have become used to it. So subsidiary A will need to find an auditor at some time in the future. That's necessarily going to add to the cost base of the process. It also means that it's quite possible that B and C would also need an audit as well. Now, there is potentially a fix here in respect of this, and that fix would be this. Subsidiary A, which is based in the UK, could issue the guarantee to subsidiaries B and C. That's not a problem. B and C would then get the exemption. But now subsidiary A will need to prepare group accounts, and it might have an issue now under ISA 600. So ISA 600 requires the auditor to consider significant components within this group, because subsidiary A is going to have to prepare group accounts. If it doesn't prepare group accounts, then it will not be able to issue the guarantee. So subsidiary A will not be able to use either sections 400, would not be able to use section 401, because in order to be able to issue the guarantee, it has to prepare group accounts. So if subsidiary A is preparing group accounts and those need to be audited, the auditor may not be able to get sufficient evidence with regard to the results of B and C as significant components, so you could end up with a modified audit report as far as subsidiary A is concerned. So just to emphasize the point that I've just made, I think of all the changes that I've looked at this particular point in time, this is the one that is likely to have a significant impact. Finding situations where parents outside of the UK, but in the EEA, have issued these guarantees is perhaps more often seen than you may actually anticipate. And some of you may see it from a practical point of view on a regular basis. Now that brings me to the end of the presentation. Slightly over time. It's now 13:46, so I'm around about 1 minute over time, for which you please accept my apologies. And I'll just now pass back to Tony for him to deal with any questions that may have arisen. Thank you very much.
I think that's pretty good. Pretty good by my book, Mike. Thanks ever so much. Another informative session. I'm sure everyone's got plenty from it. The feedback's been good on the chat. So we've got 2 or 3 questions, which I think we should have time for, which I shall read out and put to you. So the first one that we had was, could you change the period end to move the changes further into the future?
Yes, my understanding is yes, you could. So you could shorten your accounting period to before the 31st of December. So your next accounting period commenced after that date. So please remember, as I said, you can shorten as often as you like, and there's no limit by how much you intend to shorten. So effectively, you could shorten the period to perhaps the 28th or the 29th of December, and that would appear to be satisfactory as far as this is concerned. But again, this would need just to be looked at very, very carefully indeed.
Excellent. Thanks, Mike. So the second question that we've had through is, which of the changes do you consider to be more relevant to entities in the UK?
I think the one that I mentioned last, which is section 479A, simply because it has consequences which are much more far-reaching than any of the others. If you lose your audit exemption, that automatically means that is going to incur additional costs. So if you go back to the example that I just mentioned, you could end up with having to think about, so is A going to give the guarantee to B and C, go through the process of preparing group accounts. It might end up with a modified audit report, but let's be quite honest, some companies aren't actually that worried about a modified audit report, so that in actual fact may be quite relaxing as well. But there's still going to be a requirement here to have an audit. And let's be quite honest, you're not going to get an audit for much less than four figures, not including the pennies. You aren't going to get an audit for, shall I suggest, here it's going to be fairly controversial, I know, but I'm going to suggest you probably won't get an audit for much less than £3,500. But that will depend on what part of the United Kingdom you're in. And I fully appreciate the £3,500 may also be what's called understated from an auditor's perspective as well.
Cool, thanks for that, Mike. And the final question that we've got time for today. Are there any other entity types which may be affected by these changes, which you've not covered in the session?
I think the only other ones to bear in mind is that limited liability partnerships also follow many of the same requirements as applies to companies. So you may well find exactly the same scenarios existing for LLPs as well. It's not universal and across the board, but very often they can get exactly the same exemptions on exactly the same basis. So they're the only other grouping that would need to be considered.
Cool, excellent. So if you have put any other questions through, don't worry, we don't have time to cover them off today. But what we will do is we'll collate them all up, and then we've got our final session next Wednesday, same time again to run through the questions that we haven't had time to cover, and a few more as well. So don't worry too much about that. So onto the final piece here. So unfortunately, that's all we have time for. Thank you for attending Professional Accountancy Online Live, sponsored by Free Agent. Thank you very kindly to our expert speaker, Mike Ulrich, and thank you again for all of your questions. Please don't worry if your question wasn't answered today, as we'll be collating them all together and over the past 2 weeks as well, and we're addressing these all in the final session, probably with a few extras as well, which is at 1 o'clock on 16th of December. Next week's session is a full hour of Q&A, so please do put your questions to our expert panel. If you think of any questions you'd like to raise, please don't hesitate to submit these via Webinar Jam either before or during next week's final live session. Don't forget to join Professional Accountancy's online community on LinkedIn to continue the debate after the live session and be included in exclusive offers for next time. As I mentioned at the beginning, a recording of today's live webinar will be sent out via email. I've seen a couple of questions come in on the chat about that. So yeah, don't worry, it will be sent out to you via email within a couple of days. There will also be some feedback forms for the event, which help us to improve for the future and cover what you guys want to see. These will be sent out when the event closes, and by completing this, you will receive your CPD certificate. Please don't forget to visit the online exhibition at www.profaccountancy.com. By visiting the exhibition, you can guarantee access to an extra hour of CPD webinar from the 2020 Distance Learning Catalogue. You can also visit our exhibitor profile for more information on Free Agent, who are the sponsors of today's webinar series and all the webinar series. I'll stay on for a couple more minutes just in case there are any other questions, but if you would like any further information or contact details, please just do let us know. Thank you again, and see you next week for our final session, and have a great day. Thanks, everyone.